Here we go. Marc Gerstein, you have a small cap, less than $5 per share stocks newsletter. What's the fascination there?
Okay, how many times have you had a stock idea told to you and you ask the price and it's $2 a share, automatically you perk up without even asking what it is? We all do it, we're all human.
Give me thousands of it, right?
Right. You always have the visions of the big hit. The problem is there's also the big risk. The whole purpose of the newsletter is to try to attach big-time analysts to these big-time risky situations.
So what do you come out of a fairly respectable pedigree. Where'd you come out of?
ValueLine. And I evaluate these companies the exact same way I looked at the big caps at ValueLine. These are regular businesses.
And I'd say, all right, since July you launched the letter, you've had a couple companies that have been taken out and that have gone up pretty well. It's been a good market. What's been going on?
Well, there's been a tremendous demand for these stocks. The market as a whole has been healthy. This part of the market has been exceptionally healthy. Model portfolio is up huge, over 100% since July. How long it continue? You can't be complacent, but you can't ignore these gains either.
This is pretty good validation for the whole idea that you could take small stocks like this and apply a valued methodology to look for them.
Well, also what's interesting is I've done a study where you take stocks under $1, track it from '01. The gains are above the trillions. The problem is you can't trade them. Even a retail customer puts in an order and you've disrupted the market single-handedly. But I take stocks trading between $1 and $3. Huge gains. But there are 799 stocks on average every 4-week period. You can't do anything with that.
Right.
Go to refine a model, get to a top 40. You're still turning $100 into over 3,000 from '01 to '11. Now you're down to 40 stocks. Go further to the model portfolio, which is a top 15, a number you can own them all, and now we've turned $100 into about 8,000.
Cool.
And that's
so you have 40 stocks, then you have 15 also that you can look at.
And what the key is, you're adding analysis to the low price. In other words, you can get good gains statistically without the analysis, but you can also have your worst performer averages minus 80%.
Right.
When you add the analysis, my worst performer averages minus 19%.
If anything, these guys are high beta stocks, right?
I think they've left beta behind years ago. I think they're way up there in the beta.
So one of them you're talking about was Casual Male Retail Group, plus-size men's store.
Right.
What's this looking like?
Okay, it's looking like a great market because there's a very badly underserved niche. Now, you can still have a great niche but still do business badly.
Yep.
This company has not done a very good job of doing its business for a long time. They've had a bankruptcy they've come out of in 2002, but now they're actually getting better. They're getting serious about the little boring details of merchandising, store appearance, marketing programs, loyalty programs, online distribution. A lot of little boring, plain vanilla nuts and bolts thing they're doing better.
I met that CEO. He seems like he's really on the warpath. He's doing all right. Another one you talked about to me earlier was Charles and Colvard. What's that?
This is an ideal type of low-price stock speculation. It could go to zero if things go wrong. But in 2005, 2006, it was above $10 a share with revenues of $40 million. They sell what's called affordable luxury, and they're trying to create something completely new, a gem called moissanite. It looks like diamonds. The gemological properties, brilliance, luster, etc., are very similar to diamonds. The price is lower. After 05, 06, customers who were interested in luxury didn't have any more money, and the stock got hammered. They're rebuilding it now gradually. They've got the former chief marketing officer from Zales is on the board of directors. That helped give the stock a boost. You have double-digit potential on the upside, and of course the zero on the downside.
Right.
But the company is debt-free. They've really got their costs in line, and they're running it like a real business, not a speculation.
Okay. So you look at these stocks, fundamentals and technicals, or more fundamentals?
Fundamentals, but momentum is part of the model because I'd like fundamentals that the market's starting to recognize sooner rather than later. It's nice to hold a stock for 10 years. If you could hold it for 10 weeks, it's better.
Yeah. An attractive corpse doesn't get up and run.
Right.